All right, you guys, we go ahead and sprint to the end. Turn on the light. Now, by the way, before we get started, any questions on anything? You guys doing good? All right. So all of this had to do with purchases. Now let's go on to sales. Okay. So here's an overview. So what we're going to do with sales is it's a parallel process. Now, here are the sales is a revenue account. It's the revenue account when you have a merchandising store. So you'll see sales, that is the revenue account. When a merchandiser sells inventory, goes there. Now here you have less sales discounts. Now, a purchase discount, the ones we've been talking about, is when your wholesaler offers you a discount for prompt payment. This is you offer to your customers. So these customers paid within the discount period and got a discount. Okay, that's a sales discount. So a purchase discount is between the retailer and the wholesaler. A sales discount is between the customer and the retailer. Sales returns and allowances. This is stuff your customers bring back to you. And if you have sales minus sales discounts plus sales returns and allowance, it leads to net sales. Then you subtract cost of goods sold. Cost of goods sold is how much you paid for the goods. So you paid $230,400. You sold them to your customers for $321,000. That's the difference. So, okay, and then that made you mark them up $84,300. Does that sound good? All right. Now, let's go ahead and get into the journalizing for that. And don't forget, this is all the perpetual system. So let's see, how are we doing for Black Friday? There's not enough there. Is there enough here to put everything in one so it's kind of condensed? Or should I? Let me do this. Why don't I? Hey, let's see how this will work. I'll go ahead and blank this one. Now, is this creative or what? How will this work? It's too dark. Oh, Daniel, you're with us. Okay. Yeah, all right. Listen, let me turn on the light just to make sure everybody stays awake. That sound good? All right. And then I think that way, I think when we have a review, it'll all be nicely together. So don't forget. Now, see, this won't be good. Let me put this up here. So don't forget, this is all on the perpetual system. So this is all with perpetual. Now, it's periodic, it'll be different. Okay? So let's start with the sale. Now, on the perpetual system, every sale, you recognize revenue and you recognize expense. So every sale on the perpetual system, you recognize the revenue and you recognize the expense. So all the revenue and expenses accounts are updated every sale. Okay? Now, let me show you what this means in practical terms. So in this case, on November 3rd, Z-Mart, same company you've been working with before, but now they're selling this stuff, Z-Mart. What they did is they sold 2,400 merchandise, and they paid, all right, this is a better way of wording it, which cost Z-Mart $1,600. Okay, so Z-Mart paid their wholesaler $1,600, put them on the shelf, marked them up, and sold them to the customers for $2,800, right? So this is retail, that's wholesale, is another way of saying the same thing. Now, here's what the transaction looks like. So it'll be November 3rd. The first thing we're going to do is recognize the revenue. So when we do that, we're going to debit accounts receivable and credit. We're going to debit accounts receivable for $2,400 and credit sales for $2,400. So sales is the name of the revenue account, okay? And this recognizes the revenue. Now we're going to recognize the expense. So again, in November 3rd, cost of goods sold will be debited for $1,600, and merchandise inventory now I'm going to start writing I and B for inventory to move along. That's just an abbreviation for 1,600. So what we're doing now is we're converting the asset into an expense. Okay, and here we're recognizing the revenue. And what this does is on the perpetual system, every sale, all the sales related accounts are updated every sale. And that requires 4 entries or 2 pairs. The first pair recognizes the revenue, and the second pair recognizes the expense. Okay? And then after the sale, all these accounts are made current. Okay? Now, your customers pay within the discount period. Okay? So when they do that, what happens on this thing is, again, in this case, it's 210 net 60. So what happens is your customers pay November 22nd. Just curious, what do you have the dates here? November 3rd. They changed the dates on it. All right. You have a second set of transactions. All right. Let me just put this up here because I think it'll be the easiest thing to do. So now, is everybody okay with this? All right. Let me show you another sale and a sale involving a sales discount. So now, this one, Z-Mart sells $1,000. It cost $600, and it's 210 net 60. So on November 12th, they make the sale. And when they do that, all right, what they make the sale, it's a credit sale. What are the 2 entries? Accounts receivable, absolutely right. So you're going to debit accounts receivable, and that'll be for what? 1,000, sure. Okay. If the debit is accounts receivable, what's the credit? Sales, sure. You're recognizing the revenue. Okay. Now, what's the second pair? You're going to recognize the expense, exactly right. And what gets debited and what gets credited?
Cost of goods sold.
Cost of goods sold, which is the expense. And for how much?
600.
600, sure. In other words, this is what they paid their wholesaler. They paid their wholesaler $600, right? Cost of goods sold gets debited, what gets credited? Merchandise inventory. And so what you did here is you recognize the revenue, you recognize the expense, and when you recognize the expense, you're converting this asset into an expense. Okay? Now, let's go into the next transaction. November 22nd, which is within the 10 days, your customers pay you, right? So they qualify for the discount, the 2% discount. So, we have $1,000. We multiply it times 2%. That turns out to be $20. So, here's what happens. We're going to debit cash, and if they owe $1,000, take $20 off, they're going to pay us $980 in cash. Sales discount will be debited for the $20, and the accounts receivable will be credited for the full amount, the $1,000. Okay. Now, sales discount. it gets debited. What kind of an account do you think sales discount is? It's a contra revenue account. Okay? So, in this case, the net the net sales would be $1,000. That'll be a credit to the revenue account, less the sales discount, a debit to the contra revenue account. That would, at the end of this, the net sales would then be 980. Sales minus sales discounts. That sounds good? Okay. All right. Now, let's go to sales returns. Now, the thing about it is, sales and sales returns, both of those have four entries. Okay? So, let's get into sales returns. So in this case, and again, what we're going to do, it's back to the 24 and the 16. So on this sale, your customers now return items. So your customers return $800 worth of merchandise, which cost $600. Okay? So this is what it looks like. Let me put it up here and then we'll discuss it. So, and they returned it on November 6th. So what happens here is sales returns and allowances. That will be debited for the 800, and accounts receivable will be credited for the 800. Okay? And then on the 6th, now what you did is, so this recognizes the return, and it recognizes the retail price. This is what your customers paid you for it, right? Okay? Now what happens on this thing is, then it's still good merchandise, so you put it back in the shelf, right? So when you put it back in the shelf, it looks like this. It goes back in merchandise inventory. For $600, and it comes out of cost of goods sold. Okay. So, sales returns also has the 4 entries. The first 2 reverse the revenue, and the debit goes into sales returns and allowances. Now, what kind of an account do you think sales returns and allowances is? Contra revenue, right? Okay, and it's used to calculate net sales. And what you're doing here is you're putting it back on the shelf, and you're debiting cost of goods sold. Now, Kristen, I see a quizzical look.
Well, I'm just wondering, so if the merchandise is defective, and you can't just turn around and put it back on the shelves, then you go back
Then it's nothing that would surprise you. You gotta just return it to your wholesale.
Okay.
Now, let me offer another one along those lines. Suppose your customer came to you and said, listen, I really like this thing, but look, it's got a scratch. If you give me a discount, I'll just keep it. If that was the case, then the second transaction would not be recorded. Okay? Does that make sense? So the second transaction is recording being something that you can resell. If you couldn't resell it, if you gave him just a discount, right? Then you wouldn't put the second one in there.
Where would the discount take it?
Yeah.
Where's the discount go then?
How would you account
Like,
for
would you
the
discount the
discount?
$800 or?
Oh, in this case, it would only be the $800.
Okay.
There wouldn't be a second one.
Okay.
And what it is, it would, in this case, now by the way, sales, returns, and allowance. The allowance part, the returns when they actually bring it back, right?
Mm-hmm.
The allowance is when you give them the allowance. Like, look, it's got a scratch, marks the books up, I'll keep it. That's the allowance part.
But then where in your books do you mark, like, hey, I gave him 10% discount, so now you have $80 that you paid out?
Yeah.
where do you then account for that $80?
I'm sorry, so you're saying that they paid it within the discount period and got the discount?
No, so what I'm
Okay.
saying is like if somebody, say you're Best Buy, someone brings you
Yeah.
back a TV that's scratched,
Okay.
and they say, if you give me 10% back, I will keep it.
Okay,
Where do you account for the $80 that you pull out of your cash register and give them?
right here. So let's say it's an $80 discount, and let's say instead of accounts receivable, it was cash?
So then you don't have to do the 800 at all, because they're keeping the merchandise, you just have to record the, okay,
Yep.
okay.
Mhm. Yep, and that's the allowance part of this. And that second transaction means you're gonna put it back on your shelf. And if for some reason you don't, like it was unusable, okay, or it was, this is a discount. Now, if it's unusable, then you may have something to settle with your merchant, with your wholesaler, and that's just a different matter. All right, so let's do this then. Let's do quick study. All right, let's do quick study. 5-4. If I'm on page 209. So let me read it. Now, by the way, there's an example. I'm going to pull down these screens so this will disappear. There's an example on page 187. If you want an example to follow when I pull down the screens to cover the presentation. All right, quick study 5-4, page 209. So here's how it reads. Okay. Prepare journal entries for each of the following sales transactions of a merchandising company. Show supporting calculation, consumer professional inventory system. So on April 1st, you sold merchandise for $2,000, granting the customer terms, credit terms of $210. EOM stands for end of month. So the deal is you give them a 2% discount if they pay within 10 days. They can, or they can pay it at the everything's due at the end of the month. EOM is end of month. Invoice dated April 1st, the cost of merchandise is $1,400. Then on April 4th, the customer on the April 1st sales returns merchandise and receives a credit of $500. The merchandise had cost $350 and is returned to inventory. And then you receive payment in the amount due April 1st. Okay? So don't forget the sale and the sales return, both of those will have 4 entries. There you are. Other people are still working on this. You guys, let me put this up here. Then we give you a minute to look it over, and then we'll see what questions there are. I'm going to turn the light so it's more readable. All right, let's just go over this. So, the first one now is they sold merchandise for $2,000, which cost $1,400. So, the first, you recognize the revenue with a debit to accounts receivable and a credit to the revenue account, which is sales. And then you recognize the expense, and you convert this asset into an expense. So you debit cost of goods sold, and you credit the inventory account. Then, and of course there's 4 entries on that. Then on the next one, your customers return some of the merchandise. So when they return it, again there's 4 entries. The first 2 are at retail. And so you reverse the revenue, so you debit sales returns and allowances, which is a contra revenue account used to calculate net sales, and you credit accounts receivable because they don't owe it to you, right? Then, in this case, the goods are returned to inventory, and then you recognize that with the second pair, so you debit merchandise inventory and you credit cost of goods sold. So you take it out of expense and you put it back on the shelf. You reverse the first entry, or reverse the second entry. Then they pay you. Now, accounts receivable started out at $2,000 and then was reduced by $500, so now it's $1,500. So this is the amount they're paying off. Now, you can then multiply that times 98% to get the cash they owe you. The difference will be the sales discount. Or you could have multiplied it times 2%, gotten the $30, subtract that from 1,500, got the $1,470. Both will give you the same answer. Doing good? All right. Now, let's do this. See, everybody done taking notes? You have a second on that? All right. Now, I've got, the next project is really good because it takes the same transaction from the point of view of the buyer and the seller, but it will take more to do it than the time we have left. So I think what I'll do is keep it for the start of the next class, and we'll do it as a review, and then we'll go on to what follows, okay? So let's go ahead and do our review to move this. Oh, we do have one more topic on today, but let's do the one more topic, and then I'll come back and do that. Okay, so the next topic then is, let's take a look at the adjusting entry. So, if you take a look at the balance in your ending inventory account, and by the way, let me just double check. Any questions that we just went over? All right. So let's do this. Let's get into the adjusting entry for this. Now, what happens here is when you debit the inventory when you buy it, right? And then you credit inventory for the purchase discount, and you credit the inventory when you make a sale, right? Okay. The balance in the inventory account should be what you have left, right? So, but what doesn't it account for? Well, it doesn't account for shrinkage, and it doesn't account for shrinkage, and shrinkage is a technical term for theft, in effect, your customers or the employees, okay? So what you do on this thing is, here's an example. So the inventory account has a balance of $21,250. So you do an actual inventory. And you discover the actual inventory is 21,000. This means that 250 is missing. Okay? Now, you don't know whether it's theft, it's missing. Employees, somehow it went up, it's bye-bye. Okay? So, the balance should be pretty close to being accurate, but it doesn't, but all it says is this is what you should have. This is what you really have, this is what's missing. And the interesting thing here is when you take a look at theft, you have a store, right, retail outfit, you have customers and you have employees. Who do you think will account for the bulk of the theft? Employees, yeah. You go into like a 7-Eleven store and they have like 10 cameras, 3 are on the customers, 7 are on the employees. But again, it's just because they're your biggest vulnerability. All right, so what you want to do is you want to account for this. So, now, the point of the matter is, it's going to be some sort of an expense, right? It's the cost of doing business, it's going to show up as some sort of an expense, right? The expense account is called cost of goods sold, so this will be an adjusting entry. Let's say it's December 31st. Now, the expense account that it shows up in is cost of goods sold. And that'll be debited for $250. And then merchandise inventory will be credited for $250. So now the asset will be lessened by the amount that's gone, and the amount that was pilfered shows up as an expense, and the expense account is the cost of goods sold. Okay? All right, let's do quick study. 5-6. You find that on page 209. And this is the adjusting entry under the perpetual system. So this is what it looks like. So here's how this one reads. What it says, perhaps it's easier to read. So what it says is the next company ledger on July 31st. Its fiscal year end includes the following selected accounts that have normal balances. And it is a perpetual inventory system. Now, by the way, this will work differently under the periodic. Okay? So, merchandise inventory is $34,800. Capital is $115,300, and so on. Now, they do a physical count of the year-end inventory, and it discloses the cost of the merchandise still available of $32,900. Prepare the entry to record the inventory shrinkage. All right. All right, and again, what you do now is 34,800 is what you show on your books. 32,900 is what you should have. The difference is what has been pilfered. You debit cost of goods sold, you credit inventory, and you convert it from an asset into an expense. All right, you guys doing good? Done? Any questions? All right, let's have a review. Move this into long-term memory. So, and by the way, nice job, Dave. We covered a lot of material. Good job, you guys. Keep up the good work. Always pays to stay awake. So, let's go back to the very beginning. What's a merchandising business? One that has an inventory, right? When it buys an inventory, takes title, puts it on the shelf, marks it up, sells it, right? And now when we did a service business prior to this, it was revenue minus expenses equals net income, right? How does this differ? What's the name of the revenue account when you have merchandise? Sales, right? And of course, what's net sales? It's gross sales minus sales returns and allowance minus sales discount, right? That's the net sales. Okay, and two things, if your customers bring it back, it's technically not a sale, and if your customers don't pay for it, it's not a sale. Okay, so that's net sales, it's just a more accurate figure. Then you take away expenses to get net income. Now, what goes into calculating merchandise available for sale? There's two things. Beginning inventory and net purchases, right? So those are the two things that constitute merchandise available for sale. Then, at the very end of the accounting period, that merchandise available for sale, it breaks down to two and only two categories. What are they? Ending inventory and cost of goods sold. Ending inventory versus what's left in inventory, which you didn't sell. What is cost of goods sold? It's what you did sell, right? So it'll break into one of those two categories. So if you know the ending inventory, you can calculate the cost of goods sold, right? They don't give it to you, but you can just figure it that way. All right. How many inventory systems are there? Two. And what are they called? Perpetual and periodic. Which one have we been working with all day? Perpetual. Only the perpetual. The periodic will be different. Okay? What's the advantage using the perpetual? All the accounts are updated. Every sale, all the accounts are updated. What's the advantage of the periodic? Better information to make a decision with, and we'll show you that guy in a minute. A trade discount. Why do you have a trade discount? What's the purpose of trade discounts? What's that?
Influence cash. You get cash on there.
Oh no, that's a cash discount. The cash discount is the reward for early payment. What's the trade discount? The trade discount is where you have one catalog multiple customers. And it's the way, so what it does is it enables you to figure out how much you're going to pay for your merchandise. So, and the advantage is when you only have one catalog, it's a lot less expense and it's a lot less confusion. So you got the retail price. If you buy it at lots, you'll be a wholesaler, so you get a discount. If you buy 100 lots to 100, you get a retailer. You and I pay the wholesale, we pay the retail, okay? But its purpose is to calculate how much you pay. The cash discount is the reward for repayment, and it does two things. What does it do? If you offer, why would you offer it? Nice job, Candy. You improve cash flow and it lessens your bad debt. You're more likely to get paid and you're more likely to get paid sooner, okay? 210 net 30 is a piddling amount, why bother? What's 210 net 30 mean in APR? 36%? Okay, all right. Now, let's go over here. So, let's do this. Now, when you buy merchandise, okay, when you buy merchandise for resale, what account gets, okay, what account gets debited when you buy merchandise? Merchandise inventory, right? It's merchandise for resale. What two things go into the valuing every asset? How much you pay for it, plus everything it costs to get it in working order, okay? So, when you have merchandising and inventory, you debit the inventory and credit accounts payable. Okay. Now, when you return merchandise, make sure you don't take the discount off returned merchandise. That'll come up in the homework quiz, whatever. Okay, it's actually how much you owe at the end. When they say debit memorandum, what's the debit mean? What's the debit refer to? It refers to whatever happened in the sender's accounts. So a debit memorandum in this case meant the accounts payable is decreased. A credit memorandum from your bank means your account increased. All right, what's FOB stand for? Free on board, okay? What does it tell you? Where the title changed hands. Now it's FOB shipping point. Who owns it in transit? The buyer, right? The retailer, the buyer. Who's responsible for the shipping charges?
The buyer.
The buyer, whoever has the title. What if it's FOB destination? Who owns it in transit? The seller, sure. Now, all right, now if it's FOB shipping point and you're the buyer and you're buying merchandise, what account gets debited for the freight charges? Merchandise inventory, because this is part of the, it's the value of the inventory, it's the value of every asset, it's what you pay for it, plus whatever it costs to get in working order. If it's inventory, that means getting it to your store, okay? So you debit merchandise inventory. One other thing is, when you return, or when you, if your wholesaler offers you a discount, and you take the discount, right? So let's say the discount you get qualifies for it, the 210 net 30 is $24. How do you, where does the $24 show up in your books? It's a credit to merchandise inventory. And why? It's because the cost of this asset decreased by that amount. Sound good? All right. Now, let's get, so all of this was purchases that we just dealt with, right? And everything of that was always at cost. Now let's get into sales. Let's get into sales. Again, this is the perpetual system. Now it'll be different with the periodic, but it's a perpetual. When you make a sale under the perpetual system, you buy something and that's scanned across the Scantron, what two things are recognized? Revenue and expenses, exactly. How do you recognize the revenue? You debit accounts receivable and credit sales. How do you recognize the expense? You debit cost of goods sold, which is an expense, and credit the asset. You convert this asset into an expense. Okay? All right. Now, your customers pay within the discount period. And let's say your customers qualify for a $20 discount. What account does that discount go into? Sales discount. And it's a debit, right? What kind of an account is sales discount? Contra revenue. Okay? Now, all right, so now, okay, I'm just looking at this. Okay, so now, so there's 4 entries, 2 pair, when you sell something under the perpetual system. How many entries are when your customers return stuff under the perpetual system?
4.
4, okay? The first pair unwinds the versus sales return. The first pair unwinds the sale, okay? And the second pair puts it back in inventory. We ended up erasing it here by way of the discussion. Does that make sense? Everybody okay with that? Okay? And then, the balance in your inventory account is how much should be there. You do an actual inventory and discover a different amount. What do you do with the difference? You debit cost of goods sold and you credit the inventory. So the inventory will be lessened by the amount that's gone, and the amount that was pilfered is an expense, and the expense account for that is cost of goods sold. Nice job, you guys. See you Tuesday. I'm gonna get past you guys and have a... It's done.